Insights for the informed investor.
Hello everyone and welcome to my YouTube channel. In this video, we will continue with the second part of the series. How does money and our global economic cycle work? Stay tuned. In the first part, we covered the Neolithic period, the first city foundations, traditional means of payment, and the first coins. If you missed the first part, no problem. I'll link the video in the description. The first banknotes. Who produced the first banknotes? Who first came up with the idea of putting banknotes into circulation? This is a crucial question when dealing with the topic of money. After all, banknotes are still part of our monetary system today. Many people can no longer imagine the monetary system without banknotes. Just think of the fact that cash was to be abolished, and this led to great resentment. India is an ideal example that shows that banknotes are a strong component of our payment system. In India, large notes were abolished against the backdrop of the elimination of black money. This happened overnight. The result was all the more devastating. For days, there were protests and strikes directed against the passing of the law. The issue has been taken up again and again in numerous South Indian films. This alone shows how strongly the banknote has established itself in our society today. The first banknotes came into circulation because it was simply too cumbersome to pay with numerous coins. In the 9th century, the Chinese developed paper money. However, it took another 800 years for paper money to reach Europe. In addition, the first paper money in Europe was printed in Sweden. In July 1661, the Stockholm's Banco put the money into circulation. As at the beginning of every revolution, people were skeptical this time too. They did not trust paper money, even though it was very practical. The crucial question was what value paper money had. Gold and silver had a value that could be measured, but what was the value of the paper on which the money was printed? To solve this problem, the banks developed a very simple system. For every single banknote they issued, they had the corresponding equivalent value in gold in stock. The value of an issued bill was therefore covered by gold. So, when was the German mark introduced? It took a few years before Germany had a monetary system that worked well. In 1871, under Bismarck, the law introducing the mark was passed. Alongside this law, the Pfennig was also adopted as the imperial currency. Prior to this, the mark was merely a unit of weight. One Cologne mark weighed approximately 234 grams of silver. With regard to the development of banknotes, it can be said that nowadays the equivalent value of a banknote is no longer determined in gold or silver. Instead, numerous other factors have an influence on how much a country's currency is worth. For example, the value of a country's currency is determined by its debts or the amount of securities it owns. As you can see, the banknote did not spread around the world immediately. It took decades before it really arrived in Germany. Nevertheless, Germany did not have a stable monetary system. Just look at the developments after the First and Second World Wars. The monetary system only lasted for 30 years before Germany fell into a severe economic crisis which led to hyperinflation. The first banks. How did banks come about? What is responsible for this? The first banks were created for one reason. The different currencies used in bartering had to be converted into the correct ratio. This was an indispensable economic step for the major trade fairs and, above all, for long-distance trade. Entire professions were soon dedicated to this step. This profession, which conducted business at a bank, was ultimately also called a bank. The earliest activities of a bank, as we understand them today, were found in northern Italy. Even today, many banking terms are in common use that actually originate from Italian. The mere conversion of currencies was soon expanded to include other activities. These included the granting of loans. Over time, banks also began to issue bills of exchange themselves, which meant that merchants were offered more protection. But when was the first bank established in Germany? The Fugger Bank is considered to be the first official German bank. It was first mentioned by the Augsburg City Council in 1486. At the time, Jakob Fugger financed both the secular and clerical elite. The oldest private bank in Germany is Barenberg Bank, which was founded in 1590. As you can see, banking has always played a central role in the German state. Today, we simply can no longer imagine a German state without a bank that provides a framework and regulates its affairs. Money and trade in transition. However, it soon became clear that precious metals were just lying around uselessly in bank vaults and were causing storage costs. Why was that? It was because all the precious metal was not being used at once. The merchants recognized the potential of this circumstance, so they came up with an ingenious idea. They observed that only a fraction of the merchants and traders exchanged the banknotes back into gold. Many of them simply passed the banknotes on without ever exchanging them back for gold or silver. In this way, the banks put unbacked banknotes or promissory bills into circulation on credit for the stored gold and silver. The banks knew that they could not easily increase the precious metals in their vaults, but they could increase paper notes. The traders and merchants did not know that the banks were issuing further promissory bills for the stored coins without their knowledge. At some point, there were several banknotes for each gold coin. If the credit money remained in circulation, then the bank would also have to deposit additional gold coins in the vaults. Of course, this could always work as long as nobody noticed the fraud, and many owners of the banknotes suddenly wanted to exchange the bills back for gold. This would have immediately caused the bank major payment difficulties. The hard-working citizens who stored the gold were ultimately the ones who lost out as a result of the uncovered paper money or promissory bills. As financiers for merchants, banks financed global trade. Banks also helped rulers finance their lust for war. This gave the banks political influence. When, at the end of the 17th century, many bank customers in England wanted to exchange their paper money for gold at the same time, it soon became apparent that the bank's gold reserves were empty. The banknotes could not be exchanged. Public confidence was shaken, so the bank solved the problem by printing 1 and 2 pound notes in addition to the 5-pound notes. Although the bank's business was associated with risks, and some went under in the course of history, the triumph of paper money was unstoppable. Although there were already harrowing experiences at the time, the banks took advantage of the people's ignorance to grant further loans and promissory bills. In addition, the banks lent out money that did not belong to them and charged a fee in the form of interest. The interests and opportunities of the banks were simply too strong. The common people, just like today, did not understand what was being played here. At that time, the Christian churches had enormous influence and, from the church's point of view, money transactions were dishonest. It was declared a sin to ask for money in return for lending something to others and taking interest. Jews were often the money lenders in the Middle Ages. The Jews at that time also had few professional opportunities, as they were forbidden from practicing a trade. As a result, some Christians repeatedly resented the Jews when they became rich by lending money. But there were also Christian businessmen who lent money for a fee. What happened back then has not really changed today. Even today, banks lend a lot of money to people. However, there are usually not enough reserves to cover the bank's monetary capacities. They simply have to deal with the global economic crises that have occurred. Because of our current monetary system, there is nothing we can do but wait for the next economic crisis and then take the next steps. This is the simple model that you can understand if you look at the state of the economy before a crisis and after a crisis. Before a crisis, the economy is usually doing very badly. There are few job opportunities, and the national economy is in a stagnation phase. After an economic crisis, there is always an economic boom, as there is a lot of spare capacity that needs to be filled. As you can see, the economic game plays itself out again and again, and the common people are unaware of it. The gold standard. What is the gold standard and what advantages does it actually bring? The gold standard is an international monetary system. In this system, the various currencies are standardized on the basis of gold. The cover provisions and their design are variable. In the age of colonization, more and more goods came into circulation, which meant that tons of precious metals had to be transferred from one place to another. The solution was to establish a gold standard. The inevitable fluctuations in market prices were to be balanced out. Nowadays, we keep hearing voices calling for the gold standard to be introduced. But what are the concrete advantages of this standard? The specific advantages of the standard are that it limits the amount of cash available. Nowadays, banks have the opportunity to put more and more money into circulation by granting loans. In addition, the gold standard would give cash a real equivalent value. This means that stability and security are guaranteed. Savers in particular, who are suffering the most from the current low interest rate policy, would benefit from the introduction of such a standard. In addition, the gold standard would also have advantages for international trade. The national currencies would be in an exact relationship to each other due to the gold standard. The stable exchange rates and the simple conversion of different prices would promote the economy and trade. To date, all attempts to stabilize the currencies have proved fatal. On the contrary, they have led to the emergence of another crisis that has become almost unstoppable. Stability is a crucial point. Due to the current banking policy, many people would like to have the stability back that they had with the gold standard. Ultimately, this point is also leading to an ever-growing movement against the current monetary standard, which is quite understandable. Book money. What is book money and what distinguishes it? Book money is money held by a specific person in an account. It no longer exists in book form, but is stored in so-called databases. The actual money is transferred by checks, bank transfers, and the like. You are probably familiar with the classic bank transfer. You have bought a product or service on the internet. Of course, you now have to pay for it. Book money is used to enable you to do this. As a rule, the respective store operator has a bank account. You must now transfer the money to this bank account. However, you no longer hand over the money in the form of paper. You transfer the money digitally. The money is sent from your database to the recipient's database. How is book money created? Book money is created quite simply, and you already know how book money is created. You deposit cash into a bank account. This deposit of cash is mainly created by the bank granting a loan. This allows the bank to further maximize the money in circulation. The granting of credit ultimately means that the bank makes book money available to you by crediting it to your bank account. The resulting bank balances are known as demand deposits and represent a large part of the known book money. As a rule, the credit lines not yet utilized by the customer must also be added to the actual book money. These include both the overdraft facility and the overdraft facility. This area also includes term deposits and savings deposits from non-banks. But what is the effect of book money? Many people assume that cash is the most common form of currency in circulation in today's society, but is that really the case? The answer to this question is a clear no, because cash is not the most circulating form of money in society. Rather, it is book money. You should bear a few facts in mind here. In 2013, the total amount of book money in Europe amounted to around 4,858 billion euros. How is it possible for so much money to come into circulation without there being any corresponding cover? If you ask yourself this question, you will quickly realize why numerous crises are caused. This is simply because there is too much money in circulation without sufficient cover. Sight deposits are also known as potential cash. This is due to the fact that sight deposits can always be converted into cash. How can this be done? Quite simply, by withdrawing money from your account. When you withdraw money from your account, you convert the book money into cash. The central banks. If you read the news regularly, you will have heard time and again that the European Central Bank is maintaining its low interest rate policy. But what are central banks anyway, and what are they good for? Central banks are special banks that are responsible for the currency of a country or the currency of a group of countries. The ECB, for example, is responsible for regulating monetary policy in Europe. The main objective of these banks is usually to create price stability. In some countries, the central bank is also obliged to promote full employment. An important instrument of the central bank is that it can set interest rates. But how does the European Central Bank act? This is easier than you might think. It is not accessible to private investors, so you can't go to the European Central Bank and open a current account or anything similar there. On the contrary, the bank is only accessible to commercial banks. The numerous commercial banks can borrow money from the European Central Bank, for example. This money is issued so that the commercial banks can easily cover their short-term capital requirements. Furthermore, the commercial banks must provide collateral, as otherwise the amount owed could grow immeasurably. Central banks usually always have a minimum reserve. What is this anyway, and what is such a reserve good for? With a minimum reserve, the European Central Bank, for example, requires that mandatory deposits are held at the bank. If you look at this topic in a little more depth, you will very quickly realize that a lot of money can come into circulation in this way. Where is the equivalent value of the money? How is this structure set up? Due to the complexity of the banking system, it is difficult for the average consumer to look behind the facades. However, such an insight provides an overview of the bank's game, so that the final question is whether central banks are necessary. Central banks have a great deal of leeway. This scope of power has no direct consequences for citizens, but the consequences are felt indirectly. One of the ECB's main objectives was to stimulate the economy through a low interest rate policy. This goal was also achieved, as many people bought and built real estate. What is the catch? The catch is that the creditworthiness of the various people took a back seat. When granting a loan, creditworthiness is actually the decisive criterion that should determine whether a particular person should be granted a loan worth several thousand euros. By not taking creditworthiness into account, people were able to take out a large loan that they would not be able to pay under normal circumstances. This in turn meant that they were restricted in their own scope. This can all be seen as an indirect consequence of the ECB's policy. Central banks do not act on the initiative of citizens, but rather in the opposite direction. This was the second part of the series, How Does Money and Our Global Economic Cycle Work? I hope you enjoyed the video, so I would be very happy if you give me a like, subscribe to the channel, and activate the bell. That way you won't miss any more videos from me and you'll be informed immediately when a new video is published. Thank you for watching the whole video, and see you soon.